We see some labor actions with Amazon, both in their retail logistics facilities and in Whole Foods. Do you think those point to the sorts of tensions with people versus software that we're going to see in the months ahead?
I think that's probably right. It's funny because tech and Washington used to be two completely different worlds, and that's just changed dramatically. And obviously coming into COVID-19, there was a real tech lash against a lot of those companies, workers even then demanding for better conditions, sharing in more of the profits. I think on one hand, these companies, the FANG companies in particular, are working well with the government. And so there may be less tech lash in that sense coming out. And the government's going to have a lot of priorities beyond antitrust. So I think the FANG companies are going to be advantaged by that. But at the same time, you see a lot of calls for, hey, these guys are rich. Why aren't they doing more for their employees? And that's just going to be something I think we're going to have to live with for some time, and it could limit the multiples on the stocks.
Steve, going back to your point about the fact that tech has held up relative to the rest of the market, I mean, Dow's on pace for its worst ever first quarter decline on a percentage basis, yet Microsoft is actually up 3% for the quarter, despite all of that turmoil. Have valuations in tech more broadly come down enough for you to feel like there are compelling opportunities here?
Morgan, I would say valuation is not yet compelling. We have had about a 3 to 4 PE turn decline in most of the sectors, but we're still above the 215, 218 troughs, and we're well above 2000 and 2008. Now, I'm generally not convinced valuation is the reason to own or not own tech. It tends to be a momentum-driven group. But I did argue we were at an extreme on the high side of valuation. Unfortunately, I can't yet argue we're at a low point. And I would point out that even though I made the case that relative performance of tech is holding up, from an absolute point, obviously most of the stocks are down, perhaps not Microsoft, but these charts are broken. And we got a big bounce from being oversold, but in many cases, these charts are still broken. So, we still think the absolute performance of tech is probably going to be pretty questionable. But again, if you've got to be somewhere, names like Microsoft make sense.
Yeah, that does make sense. Let's make this a broader conversation, talk a little bit more internet, bring in RBC's Mark Mahaney right now, who I believe, I'm not sure if you're joining us, Mark, via Skype or via phone. Looks like via phone. It's good to have you. You put out a note. You're taking down your estimates of some names like Facebook, Google, Pinterest, Snap, and Twitter. This V, I assume you mean the V-shaped recovery, might be steeper, go lower, I guess, than you thought. What are you seeing?
Yeah, that's the third time in 3 weeks we did this. Going into last weekend, and there was three major material data points that came out last week. First, Twitter essentially pre-released and talked about March month trends being down, implied that they were down 15, 20, 25% year-over-year growth or year-over-year declines in internet advertising. Then Facebook puts out this blog for the first time ever that I've tracked the company talking about weakness in ad revenue. I've never seen them talk about that intra-quarter. And then third, one of the biggest internet advertisers out there, Booking.com, formerly known as Priceline, talks about publicly dramatically curtailing its marketing spend. You put those three data points together, and things just got worse from our perspective. So for the third time in 3 weeks, we cut numbers just on the advertising names. I think if you look at all of the internet companies, the travel, kind of hospitality names, most impacted, advertising kind of in the middle, and then you still have a few defensive plays, but they're very few, and that's the Netflix, Amazons, and Akamais of the world.
So, Mark, just to dig into that a little bit more, I mean, the fact that we are seeing this weakness in internet advertising, it's happening while simultaneously some of these very same companies are saying that their user numbers are up, their engagement numbers are up. At what point do you start to see those advertising dollar flows actually start to shift, given the fact that there are so many more people sitting at home engaged in the internet and clicking through these different sites and using them?
I think what you have is a buyer strike. I think advertisers are simply cutting back on brand campaigns and then on performance marketing campaigns. Those are two things that are happening, so it doesn't really matter what kind of engagement you got. I mean, it's great for the business long term, but advertisers just don't want to advertise in this environment. I mean, there's certain sectors that have just gone zero in terms of ad dollar spend, so that's travel, hospitality. I think a lot of major brand advertisers, consumer discretionary, particularly high-end, high price point consumer discretionary, I think those campaigns have just been stopped. Now, those could be turned on very quickly again, and we assume that they will. That's why we're going to have a V coming back. But exactly when that is hard to know. But, regardless of your engagement, I think Twitter really was your data point. Twitter is saying that they're seeing an acceleration in user growth, but the demand dollar, the ad dollars aren't following that. And I think that's the case with Google, Facebook. The advantage that those two companies have is that they'll be the last to cut because they've got the best proven ROI in terms of internet advertising, and maybe, frankly, across all ad platforms. The more second-tier speculative ad buys, call it your Pinterest, your Snapchat, your Snap, and your Twitter, those will be cut. So those you'll see a more severe Vs with those names.
Hey, Mark, it's Carl. Really quick. I mean, WPP today did pull the dividend, the buyback, their guidance, and they said we're very cautious about the impact on marketing budgets, and I think they're talking even X-travel. What makes you think that the spigot would be turned back on from non-travel related companies once we get through this?
Well, I think we'll just get back to, you need to generate demand for your products, and if you're going to launch new products, you're going to want to advertise. Twitter's usually been a pretty good place to advertise new launches. One of the big positives we saw, if I go back a little bit in history, in Q4 of last year, was kind of a surge in online advertising associated with the Disney Plus launch. There'll be other video streaming launches, there'll be other product launches, and there'll be ad budgets that'll be spent against those. I just think you're going to go through 12-week pause in new ad campaigns, especially for certain verticals, travel, high-end consumer discretionary. But those will come on. The question is the timing and whether that's in the back half of the year or early next year. Our guess right now, our working assumption is the back half of this year.